Hello and welcome. Today we are diving into a transaction that, well, it really serves as a powerful case study of the harsh reality facing some of these former tech unicorns. I'm talking about the Eventbrite acquisition.
That's right. On December 2nd, 2025, Eventbrite, ticker EB, announced they had a definitive agreement to be acquired by the Italian tech firm Bending Spoons. It was an all-cash deal valued at $500 million, which works out to $4.50 per share.
And on the surface, that sounds pretty good. An 82% premium over the 60-day average price. But, and this is the big but, it also confirms a painful destruction of shareholder value.
A painful one is right. This is a company that went public back in 2018 at $23 a share. So this $4.50 exit price, it represents a loss of over 80% for anyone who held on. I mean, this isn't just an acquisition. It's what you'd call a textbook take-under. It's a capitulation.
Which really forces us to ask the central question here. Was this deal a rational, market-driven exit for a shrinking asset? Something validated by institutional consensus? Or was this a profound failure of corporate stewardship that resulted in the board accepting a, frankly, lowball valuation? I'm going to argue that this was a necessary and rational retreat.
And I'm going to challenge that narrative of necessity. I think the valuation they accepted was fundamentally flawed, and I'll be focusing on the failure of fiduciary duty owed to the company's owners.
My position is, well, it's pretty straightforward. The $4.50 price wasn't arbitrary. It was the cold, rational conclusion dictated by the company's trajectory. Eventbrite had very clearly transitioned from a growth story to what the institutional market saw as a distressed asset. You can see the turning point in the Q3 2025 results. Now, on the surface, they beat earnings per share, came in at 6 cents versus a forecasted loss of 5 cents. But the market looked right past that, and it focused on the red flags. A revenue miss, $71.7 million against a $72 million forecast, and more critically, an 8% year-over-year revenue decline. That signaled the expansion phase was over. So the institutional investors who control over 80% of the stock, they weren't worried about growth anymore. They were worried about the burn rate. They feared management would just squander that big cash pile on turnaround attempts that were going nowhere. This all-cash offer gave them a clean, guaranteed exit.
I appreciate that focus on sentiment and, the operational history, but I come at it from a mathematical perspective. And the numbers here, they tell a story of just profound undervaluation. I find that $4.50 offer to be fundamentally unacceptable. It borders on what a lot of retail investors were calling corporate theft, especially when you look at the balance sheet.
Okay.
So let's just analyze this valuation paradox for a second. At the time of the deal, Eventbrite held over $400 million in corporate cash. You subtract their debt, which was about $175 million, and the company has a net cash position of roughly $227 million. Now, the entire company's market cap before the deal was only about $242 million. So if you just do the basic math, you take the market cap, you subtract the net cash, the market was valuing the entire operating business, the platform, the brand, the users, everything, at a mere $15 million. You're giving the whole thing away for essentially nothing. Bending Spoons pays $500 million. They immediately get $227 million in net cash, so their effective cost is only $273 million for a business generating almost $300 million a year in revenue. Selling a software platform for less than 1 times revenue is an absolute bargain. It confirms the board completely capitulated.
That is a compelling analysis based on let's call it a simple net cash calculation. But I have to challenge the premise that the market was naive enough to take that $400 million in corporate cash at face value. The institutional market discounted that cash for a very specific, very rational reason. And this is the heart of the distressed asset narrative.
Go on.
Eventbrite's whole business model involves holding money for event organizers until the event happens. In financial terms, they manage a significant creator float. And that float comes with massive liabilities. Specifically, the balance sheet showed $338 million in accounts payable to creators.
Alongside that, they held about $108 million in restricted cash. So a huge portion of that cash you cited wasn't really free to be used for growth. It was required liquidity to cover the risk of creator payments. The market correctly feared that continued operational losses could eat into that cushion, and if creators' solvency ever came into question, the entire platform would just collapse. So that discount wasn't arbitrary. It was rational risk management. The $450 price reflected the platform's value minus the capital buffer needed to maintain trust.
Okay, I acknowledge the absolute criticality of that creator float dynamic. It is the lifeblood of the platform, and its security is paramount. I grant you that. However, even with that necessary liquidity buffer, selling the entire operating engine for what amounts to a rounding error, it suggests the board didn't just account for risk, they panicked. We are talking about a major, globally recognized brand here. The fact that legal scrutiny launched almost immediately after the announcement, with firms investigating if the board fulfilled its fiduciary duties, that validates the idea that the asset was just sold too cheaply. If the board was really focused on maximizing shareholder returns, they needed to run a proper option, or at the very least a robust go-shop period to solicit higher bids. Accepting this deal suggests they just prioritized a clean, quick, guaranteed exit over the potentially higher but more complex path of a bidding war. And let's expand on the mechanics that locked this low price in. The definitive agreement itself acted as a barrier to any better offer. We call it a take-under, because the deal structure basically converts the stock into a fixed income-like instrument. It puts a ceiling on the valuation until the deal closes, maybe well into 2026. And this is reinforced by the penalty structure. The agreement includes significant termination fees, which act as a financial poison pill. A new bidder doesn't just have to beat the $450 price. They also have to pay a multi-million-dollar termination fee to Bending Spoons. That fee mathematically raises the cost for any competing buyer, and it makes a counteroffer prohibitively expensive. This is exactly why the stock traded slightly below $450, around $443, right after the announcement. The market knew a higher bid was practically impossible.
That's an interesting analysis of the arbitrage spread and the poison pill. But I'd argue the market mechanics leading up to the announcement actually confirm the institutional consensus for the sale, rather than indicating a rigged system. You have to look beyond the retail volume and examine the more technical data, specifically the dark pool activity.
Okay.
The off-exchange short volume ratio was consistently high, hovering above 40%, even hitting almost 48% just days before the announcement. Now, a retail investor sees that and thinks, wow, massive bearish sentiment. But that's a misreading of how this specialized market works. A lot of that short volume was actually market maker hedging that was masking systematic accumulation. Arbitrage funds, sophisticated institutions, they were anticipating a deal right around that 450 level, and they were systematically building large, long positions. To provide the liquidity for those huge buys, market makers shorted shares off exchange. This high, consistent short ratio suggests a sophisticated accumulation program was underway by parties who anticipated and maybe even dictated the necessity of this sale. That small spread you noted between 443 and 450, that's just a risk premium that arbitrage funds are designed to harvest. And ultimately, the value destruction we've discussed, that 80% decline, is what I'd call pure. By pure, I mean the losses almost entirely from core operational failures, not financial engineering like reverse stock splits. Eventbrite never did one. So that 80% drop was solely due to deep mismanagement and market headwinds. I mean, we can point to disastrous choices like the $200 million Ticketfly acquisition in 2017, the creator migration crisis that followed, and then, of course, the pandemic just decimating the live event industry. What's compelling, though, is that management was aggressively cleaning up the balance sheet right before the sale. They cut stock-based compensation by a staggering 42% in Q3 2025. That signals management had given up and was just preparing the company for a necessary sale. Bending Spoons provided that lifeline.
I agree entirely that the sale was operationally necessary. The management team had clearly demonstrated an inability to execute a turnaround. The historical failures are undeniable. However, the acquirer's reputation casts a pretty dark shadow on the board's choice of partner. and it reinforces this negative sentiment that they prioritized a guaranteed exit over anything else. Bending Spoons has a very public playbook. You can see it with Evernote. They buy struggling assets, they immediately implement brutal efficiency measures, big layoffs, restricting free features, aggressively hiking prices. It is a strategy focused purely on squeezing profitability from a shrinking user base, not on innovation. This suggests the board chose a buyer who would just extract value quickly rather than one who would maximize the platform's long-term potential. For long-term shareholders and, frankly, for the users, this outcome just confirms the board chose the path of least resistance.
So we keep coming back to the complexity of the balance sheet, and that's really where the distinction lies. The $450 exit price, while low, was a rational conclusion dictated by a shrinking business, a management team that had lost institutional trust, and a critically complex liability structure. The institutional consensus visible in those dark pool trading patterns, it confirms this wasn't just a lowball bid, but an efficient and necessary exit strategy.
And while I acknowledge the necessity of the sale and the operational constraints, the valuation still represents a profound failure of corporate stewardship. By accepting an offer that effectively valued a globally recognized platform at $15 million, less than its net cash, the board essentially gave the business away. This mathematical reality, compounded by the structural barriers from the termination fees, fundamentally betrayed the long-term equity holders who deserved a valuation that reflected the intrinsic strategic value of the platform, even a distressed one.
The Eventbrite story is certainly going to serve as a critical case study. It perfectly illustrates the consolidation happening in the experience economy, and it highlights the different perspectives between institutional efficiency and, well, retail investor attachment to brand value.
Indeed, and there is still much more to explore here, especially regarding the legal filings, the fairness opinions provided to the board, and the full financial impact of those termination fees.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.